Hello and welcome to this week's edition of Econoday Unplugged. It's Tuesday, 20th of October 2020. Mark Pender's in the States and I'm Jeremy Hawkins here in London. Looking around global financial markets, it's probably fair to say that central banks have made a pretty good job of keeping liquidity flowing and avoiding the sort of credit crunches and volatility spikes that we saw during the global financial crisis. True, the massive and ongoing injection of funds may be storing up problems for the future, but on the whole, monetary policy makers must be at least cautiously content with recent developments. However, a well-oiled financial system can only do so much in terms of bolstering economic growth. And while the markets may be behaving themselves, economic activity is already showing signs of struggling as it tries to recover from the effects of COVID-19. So it's quite interesting then to hear that the IMF now believes that most advanced economies that can borrow freely don't need to plan for austerity to bolster their public sector finances after the virus pandemic is finally over. This is a marked new turn from the advice it offered a decade ago when it called on governments to cut back on spending or raise taxes to bring deficits under control. So, Mark, we've recently heard what the US budget deficit has over 3 trillion in the fiscal year that's just ended. Are we
Yeah.
remotely concerned, or is the IMF right? We don't have to worry about anything.
uh, well, I guess we're borrowing for right now because of the massive impact, and ask questions later. Certainly, the world is swimming in debt. If the whole world is, and how that plays out is, of course, a complete unknown, and whether it will be inflationary, which it doesn't seem, of course, right now to be there, hardly any evidence at all of inflation. You did a German PPI report where you said that there's a floor maybe building in what is still, perhaps a negative position, at least for the PPI, the German PPI. So I think that that's probably a, a right assessment of where inflation is right now, and perhaps it won't be going any lower. But whether or not it'll spike is another question. And it's an interesting, how currencies work, whether or not there will be any devaluations or any comparative troubles with the different currencies, and how digital currencies may play into this is something that will all unfold, I guess, over what, the forecast horizons for at least the Federal Reserve, 2023. We'll see. And there's really there's hardly any sign at all of any expectation of any life in inflation. Maybe some, rosy scenarios that will be approaching 2%. But right now we're about 1.5% in the U.S. roughly, and so that's not a lot of inflation building. But if they can do this, if central banks can borrow and print money, or if governments can borrow and central banks can print money at the pace that they have, and it proves not to be inflationary, well, that would be a surprise. I guess they would have to reverse course sometime along. And what exactly? So the IFM is saying that they don't have to reverse course sooner than later, or
Yeah, I think the attitude has changed, and I suppose it comes down to what they're calling modern monetary theory these days, whereby so long as sufficient debt is held domestically, then essentially the government's got it under control, and you don't have to really worry about too many things. The problem, of course, becomes if a lot of the debt is held externally, and in that case, you really need to maintain overseas confidence, or you could get a major run on the currency. But I think it's a combination of, say, a shift towards perhaps, say, this modern monetary theory approach, together with, I suspect, the idea, well, look, when you've got interest rates as low as they are now, you really should be filling your proverbial boots with them, because you're almost being paid to hold debt rather than actually having to repay it, rather having to be. So it's an excellent time, really, to actually borrow as far along the curve as you possibly can do. But it's interesting, you mentioned the currencies in there, and I don't know if you noticed it today, but there's an interesting piece which came out from the ECB, not ECB policy by any means, but from their economists, and they come out doing some calculations suggesting that, or underlining, I suppose, the importance of quantitative easing or relative quantitative easing on the currency markets. Because I think for a lot of people who perhaps don't have much faith in does quantitative easing really do anything in the first place, and there's this big question mark over what precisely are the various transmission mechanisms. Well, if you read this ECB staff paper, they're saying if you look at the performance of euro dollar, euro versus US dollar during the course of the pandemic so far, from March to September, then a euro appreciated, well, roughly speaking, 10% against the dollar. And they're attributing 6 percentage points of that, so over half of the appreciation, to the effect quantitative program outpace that of the ECB. So what they're effectively saying is that the currency markets do respond very much to what's happening in terms of quantitative easing, and more importantly than that, perhaps, who's introducing more quantitative easing than anybody else. Obviously, with what the Fed's doing at the moment compared to the ECB, which by ECB standards is very aggressive, it's certainly not as aggressive as the Fed, and they're suggesting that's one of the principal reasons why we're seeing the dollar losing ground against the euro, or the other way around, the euro gaining against the dollar. So interesting stuff.
Mm-hmm.
The other thing was, just going back to the fiscal side and say this IMF, which we touched on briefly last week. One factor which always struck me, which stood out from the global financial crisis, and looking at how the global economy recovered from that crisis, and yeah, fair enough, it's a totally different crisis this time round, but the US at that stage reflated fiscally substantially more than we saw coming out of the likes of Europe. And if we believe the latest set of IMF forecast, and to give any forecasters credit, it's pretty difficult to get hold of all the various packages going through at the moment. But again, they're suggesting that the fiscal stimulus coming out of the United States is going to be significantly more than we see in the euro area. So although there's been a lot of people talking the dollar down, you wonder if this actually may be the case that leads the dollar to appreciate. Just to stick a couple of numbers in here. So this is looking at the structural deficit in the States as a percent of GDP. So effectively, the underlying deficit. Now, the IMF estimate for 2020, and this came out, I think it's last week, so it may or may not include all the latest packages, etc., etc. But they're talking about an increase from 6.8% of GDP in 2019 to some 15% this year. This compares with the Eurozone, which had a structural deficit to GDP of just 0.6% in 2019, and they see that increasing to just 5.3%. So in terms of the actual stimulus being provided on your side of the ocean versus what's coming out of Europe, the US recovery, one would anticipate purely on the back of this to be significantly stronger. Does that make sense to you?
Yeah, I guess it does. There's one factor though, and that's the expectations factor, or a subjective factor that may be at play here when you break down these numbers and you're talking about more QE equals 6 percentage points. That's a very precise level, but it could also reflect general concern, or a general easing of concern on the pandemic global effects, which would perhaps lower demand for the dollar. So that could, I think, be one important part. Also, how is the COVID affecting Europe? It seems to be a much bigger issue than it is here. It's a big issue here in the U.S., don't get me wrong, but it seems to be we have less lockdowns, we have higher infection rates, and maybe that it will be another, fewer lockdowns may help the U.S. economy relative to Europe. But so like I see that Wales is in some kind of a near a return to a total lockdown. Is that correct?
Yeah, I mean, you're right. I think certainly the COVID side is getting, well, it's getting almost total press at the moment as far as Europe's concerned. Obviously, you've got little matter of a presidential election around the corner as well to talk about. But over here, it's very much seeing what's become an escalating trend in the COVID numbers. You mentioned Wales, to intents and purposes, has gone into lockdown, at least is about to go into lockdown. Ireland has come out today and introduced a 6-week lockdown, which will be starting, I think, at the back end of this week. We've had yet more measures or restrictive measures, not in terms of total lockdown by any means, but more restrictions out of France, Spain, Germany, which of course was widely regarded as being one of those countries who performed best during the pandemic. Pretty well right across Europe at the moment, we've got additional lockdowns coming in. And it's important, as we've talked about in the past, not just from a health point of view, but in terms of what it's going to do to the economy. And I think what we're starting to see over here now is that some of the forecasts of anything remotely like a V-shaped recovery are rapidly being eroded out, and the concerns are that fourth quarter GDP may actually turn out to be pretty weak. And with that in mind, I think just looking to this week's figures, it's going to be an important period for some of these so-called soft surveys. Now, obviously, we're not going to have a lot of hard October data yet, or indeed even hard September data as far as Europe's concerned. But we will be getting, surveys on consumer sentiment from the GfK guys on Thursday. We'll also be getting the Eurozone flash consumer sentiment index coming up shortly as well. We'll have business sentiment coming out of the likes of ANSI in France. And of course, all the flash PMIs on Friday as well. And I think given we've had this sharp pickup in COVID cases over here over the course of the last 2 weeks or so, there's going to be almost disproportionate interest in what these particular surveys now are saying about what's happening to business activity and consumer activity as guys try to start to work out, right, what is the position in terms of the overall recovery. So have you got much coming out your side on that sort of effect?
Well, we do have the PMI flash on Friday, along with the rest, along with France, Germany, and the UK. And I think the general assessment is, at least for the US, is firm. Nothing appalling. Last week we had a very strong retail sales report, shockingly really strong in September. I guess that I think that probably implies that there is a shifting from services where people are not spending their money, of course, and going ahead and buying more goods, which is which is good for retailers. But industrial production was soft, and it's still trying to. So the supply side of the economy is still trying to dig out of its hole. And
how much of a gap is there left now? If you're looking at the IP number between where we stand now versus the the pre-lockdown stuff.
Okay, well, let me see here. Let me get my Econo Day. I had that up a second ago. Let me see here. Well, we had housing starts and permits here, but let me look at last week's. I'm just zipping around my calendar here.
Okay, so in terms of Europe, we're still running about 10% behind, but short, I should say, something like that.
I can give you the exact number. That's roughly what I would say it is off the top of my head, but I have the numbers right here. Okay. So total production in the U.S. is down 7.1% from February, with the manufacturing output down 6.4%, and that's in contrast to sales. So that's goods production, general overall goods production. That also includes goods for export, where demand has been very weak. But for the domestic consumption of goods, we have been up. We were 5.4% higher on the year. Higher on the year. So I'm not quite sure what that, but we've been up 4 straight months over the February level. So we're doing very well on the goods side, the consumption of the goods. And we're still struggling on the production of the goods now. But let's turn to how we just had the housing starts and permits number. And this is something for policymakers. I think that there's a risk here. of a unsustainable bubble emerging in the housing sector. It has just been on fire, and it's concentrated in new home sales, which are up. I don't know what the latest number is on that, but because that'll be coming out next week. But on the permit side, they were up 5.2% in the month of September, with single family homes up 12.6%. Permits for single family homes are up 12.6%. So that's home builders who the day before, yesterday, Monday, continue to report, by far the highest sentiment and the highest levels of current sales and future sales and traffic and 35 years of data for the home market index.
Within that one,
Yeah.
I mean, we got a sort of the same pattern over here, although it's not as strong a recovery in the housing market as you have your side, but particularly in the UK, something which has been very apparent is a sort of a geographical, almost redistribution of purchasing, in the sense that, since we've had the pandemic, there's been this gradual migration out of the more densely populated areas into the less populated areas. Is that the same sort of thing we're seeing on your side?
I haven't seen. That's the anecdotal. Those are the anecdotal reports. The data I've been looking at haven't been broken down by metropolitan areas versus non-metropolitan areas. That may be at play, and that would, that would make sense. And there does seem to be, if not that factor, that would increase demand for home sales, but also that higher wage earners are being less affected by the unemployment situation.
All right.
So that could be, but I think fundamentally it's the low interest rates. And they are historically low, and they are feeding. And this is direct, this has nothing to do with demographics or COVID or anything like this. Is monetary policy that is moving these, and the buying of mortgage-backed securities at a fierce rate here in the U.S. That's also helping the keep rates down. So, and how long can this go on? And certainly there's going to be these are unsustainable gains for the residential sector, sooner or later, the home, permits are exceeding starts. Even though starts have now are beginning to emerge above their February levels, permits are far higher still. Well, but starts are on their way. So how long can this go on? I guess, a central question that I think the Federal Reserve here has dodged this issue. And they're going to have to face it, and they're going to have to explain it. And so they have, the minutes of their meetings, they mention it a little bit, but their descriptions are still very contained. I don't think that that's fair anymore. I think that there is a bubble issue that is going on. And if we talk about the global financial crisis 12 years ago, that was another monetary, or it was a subprime mortgage. It led to an explosion of housing activity that we've never even matched yet. Although we will soon match it in sales and building if at this pace, if it continues. And what makes this stand out so much right now is it's how exceptional it is compared to other elements of the economy. And so it's obviously something that is of major importance. And if you recall, 12 years ago, in the U.S. at least, home prices went down 25%. And that was all part of this great catastrophe. And will something like that happen? Are we building another bubble, monetary policy a based bubble in the housing market? And if so, that could be a very dangerous thing for the recovery when we finally begin to get out of this.
Fair point. All right. Well, talking of dangerous things, we had an EU leaders meeting last week, which was supposed to be talking, or in theory, perhaps coming out with some fresh insight and progress on this much touted trade deal with the United Kingdom. So, well, the meeting came and went without any real signs of progress, which meant if Boris Johnson, the UK Prime Minister, was to be believed, the UK should have walked away since he'd set October the 15th, which was last Thursday, as being his, if you like, self-imposed deadline for there to be some real progress on these actual talks. Now, the UK contingent, although they didn't actually attend the meeting, of course, because they're not part of the EU anymore, but they made it obvious they were none too happy what came out of that particular meeting. But they haven't pulled the plug completely, and indeed it looks as if further talks will be continuing today. So we'll really have to see what happens. But although it's got to be said, the pound has been sold off since the back end of last week. It hit particularly hard. So it does still seem to be the case that investors believe that there will be some kind of deal reached at some point, rather than we all just ending up with no deal at all and both sides being hit badly economically come the beginning of next year. I think, in terms of where we go for here, well, really it's anybody's guess to how long these talks might or might not go on for. But I guess the absolute bottom line is something like November the 15th, which has been put forward as just about the latest possible day for agreeing a deal if it's going to be ratified by all the various parliaments involved in this. And of course, that process takes a long time. But in any event, whether or not they're going to get a deal or not remains to be seen. It probably means that sterling and potentially UK financial markets in general will remain volatile, perhaps amongst the most volatile of markets over the course of the next several days. It's got to be said, I suppose, looking where the pound is at the moment, if we were to see something which came out now and suggests that, well, that's it, the talks have finished, there will be no deal between the two sides come the end of this year, then you've got to expect to see the pound being hit quite heavily. You'd also see presumably a fairly sharp run into gilt-edged stocks, so yields coming down. And also, of course, it's going to increase the likelihood that Bank of England will have to cut interest rates or at least ease policy again. Now, we do have another meeting from the Bank of England on November the 5th. So we may by then know perhaps whether or not there's going to be a deal. But already from the comments which have been coming out from MPC members, it looks as if there's going to be some kind of ease taking place there anyway. It's quite clear that the bank is very concerned about the outlook for the economy, in particular the labour market, and they believe that the current unemployment numbers are too optimistic. They think the actual unemployment figures are going to be a lot higher. So it looks as if we'll probably get at least some additional quantitative easing coming out of that meeting. And indeed, of course, I think as we talked about last week, there's this ongoing review at the moment about what negative interest rates would mean for the financial sector over here. So there's at least, I think, an outside chance we could even see base rate, or bank rate, I should say, being cut again. Before then, and in the same vein, we'll get an ECB meeting. That's due on Thursday week, so Thursday of next week. There's also talk we could even see an interest rate cut there. I still think that's pretty unlikely because it seems that most of the council members seem to think that interest rates have pretty well reached their lower bound now. But there's certainly going to be speculation about possible additional quantitative easing there. And I think from the way the economy looks like it's starting to slow now, we'll either see some form of easing coming out at that meeting, or perhaps more likely, because in December they'll get the updated economic forecast, we'll see something come in then. So if you believe what these ECB economists were saying, and that quantitative easing leads to a weaker currency, then it could be that if we don't see any additional quantitative easing or change in the pace of quantitative easing out of the Federal Reserve, that the dollar might be in for perhaps some kind of a lift, because we could well be seeing some additional action coming out of both the Bank of England and the ECB over the course of the next few weeks. Mm-hmm. Okay, what else have we got? I suppose I should quickly stick on this Brexit thing. I mentioned it, although it's not clear quite what's going to come out of this yet. Folks may remember that Boris Johnson tried to put through this thing called the Internal Markets Bill, which undermine various parts of the Brexit withdrawal agreement, which was signed to allow us to leave the European Union at the back end of last year. There's now efforts apparently in Parliament to actually change or amend some of this bill to make it more palatable to the EU side. Were that to happen, then certainly it would help to boost the chances of actually getting some kind of trade bill. That particular bill itself, I think, is under discussion in the House of Lords at the moment. So it's going to be probably toing and froing between the House of Commons and the Lords over the next few days. But what comes out of that could again have quite important implications for what's going to happen as far as UK markets are concerned. Anything else we should mention? I suppose quickly out of Canada. So there's a difference at the moment between how the financial markets are behaving, which by and large is all quite nicely, thank you very much, and the real economy which aren't doing so well. Well, a further reflection of the fact that financial market pressures are easing generally. Last week, the Bank of Canada, was it on Thursday, said it will be discontinuing 3 of its COVID support programs, and that's simply due to improving market conditions. We've already seen various measures coming out of the likes of the B, indeed the reductions in the swap lines between the Fed and various other central banks, suggesting that financial markets are doing okay. So I suppose the bottom line to all this little lot is that, well, the central banks are doing their bit. Time for the fiscal policy makers, or at least some fiscal policy makers, to do rather more. End up on, I suppose, a slightly more upbeat note. If you're trying to find an economy which is doing well, or at least relatively well at the moment, I suppose you can pick on China. We had their third quarter GDP numbers, which showed an annual increase in total output of 4.9%. Now, it's a little bit weaker than expected, but up from 3.2% in the second quarter. So in line with, a fairly decent and respectable turnaround in the Chinese economy post-COVID. And indeed, the overall COVID situation out there seems to be a good deal better than most other parts of the world at the moment. And also within that third quarter data, importantly, we had accelerating growth coming out of both industrial production and retail sales as well. So China could well be one of the places to invest in over the course of the next few months, and certainly from the strength of the local currency, it looks as if investors are returning to that part of the world already.
Well, a question I have is I don't have. Let me hang on. Let me try to get the Chinese the imports numbers. Trade wasn't part of what they issued on Monday, but is China going to be buying? I know that they're buying, of course, U.S. agricultural goods, but are they supporting their export or their trading partners? I think is going to be a critical question. I see that I pulled these numbers up. So their imports in August, the latest data that I have in my sheet, was down 2.1%. On the year compared to a year ago, versus a 9.5% rise in exports. So their economy, are they going to share the wealth here? Are they going to increase their own?
I think, sorry interrupting, but I've got just looking at our calendar. We got the September numbers there. Imports on the year in September were up 13.2%. Exports up 9.9%. So I think, putting a straight, clearly with these unadjusted numbers, the rates can move about quite a lot between months. But the signs are, I think we put a straight line through it, is that, growth of Chinese domestic demand is, or should be starting to filter through to, as you say, to their main trading partners. So I think for the rest of the world, really, it's a good thing that China is doing what it's doing, and hopefully will continue to accelerate to boost, the exports coming out of the rest of the other main trading nations. So yes, it was a strong balance or strong surplus out of China, but actually a good deal less than expected, simply because the import side of it was so strong.
Okay, there you go. That was data released on Tuesday, I see here.
Yeah, that's right. Okay, right. Anything else from your side?
Well, I think it's a quiet week here. I don't think that there's any expectations.
Can we have the Mark from our side? Can we have the Mark Pender call on the U.S. presidential election in 2 sentences, please?
I would say the polls are not to be relied upon, and it's probably still up in the air. I know that there's a lot of pre-voting over here, and but how that plays out, I think that the election is still probably up for grabs. And if there is a Trump victory, I think the impact will be limited for two reasons. One, that he may not be pulling in Congress, and two, he will be an immediate lame duck. So I think that will, I think, limit the impact, at the economic impact, but I think it's still playing out, and it certainly has polarized. It's ever more polarization over here, and so well, how, I think, markets are unpredictable, and but my kind of hunch is that the markets will show less polarity than public opinion.
Okay, watch this space, as they say. Thanks for that. And that then is it for this week. To end on a happy note, I guess it seems that both Donald Trump and Joe Biden will have their microphones muted during parts of Thursday's final debate. So for those interested in what they're saying, at least they might actually be able to hear something this time. On behalf of Mark and myself, thanks as always for listening. And whatever the politicians might say, remember, you can always keep up to date with the key market moving data and events in Econoday's global economic calendar. Stay safe, and we'll see you next time. Bye for now.